Okay, let's unpack this. Imagine the global financial system feels, well, shaky. Markets are all over the place, lots of uncertainty. Where do you put your money? Or, if you're managing huge institutional funds, where's the safe harbor?
That is exactly the question for this deep dive. We're looking at safe haven, assets, currencies, investments. We've got the sources you sent us, and they're going to help guide us through it.
Right. And our mission today is basically this. Figure out what these safe havens actually are, why people trust them, and maybe most interestingly, how they behave when things get really stressful, sometimes in pretty surprising ways.
Definitely surprising. And the 2008 global financial crisis is the perfect case study for that. It really challenged some assumptions.
Big time. Okay, so first things first. What is a safe haven in simple terms?
At its core, it's an asset, could be a currency, could be something else that investors expect will hold its value or maybe even go up when the broader market is in turmoil.
So it's about reducing risk when everything feels uncertain.
Exactly. It's a flight to safety, essentially.
And the usual suspects, based on the sources, are...
Well, you've got the big ones, the U.S. dollar and U.S. Treasury bonds.
Yeah.
Then there's the Japanese yen and Japanese government bonds, the Swiss franc and its bonds, too.
And gold, right, kind of in its own category.
And gold, yes, the classic commodity safe haven.
Okay, so why these specific things? What makes them safe?
It usually boils down to a few key factors. Things like really deep liquidity, meaning you can buy or sell a lot without moving the price drastically.
Makes sense. You don't want to get stuck.
That's precisely. And historical reliability plays a big part. They have a track record. Plus, for the currencies and bonds, they're backed by governments with legal and political systems that are generally seen to have stable and trustworthy.
That foundation of trust is crucial when things feel unstable elsewhere.
Absolutely. But here's the twist, and it's a key point in the sources. They don't always act the same way in every single crisis.
So it's not like a fixed rule.
Not at all. Their behavior can change depending on the specifics of the crisis. Like, historically, you might think if a huge crisis starts in a country, even if it has a safe haven currency, that currency might actually weaken.
Which logically makes sense, right? The problem's right there.
You'd think so. And that's exactly why 2008 is so fascinating. It kind of flipped the script.
Okay, let's get into that. The GFC. It started in the U.S. housing market, spread through the U.S. financial system. So following that old logic, the dollar should have taken a beating.
That was the expectation for many. The U.S. was the epicenter. But the opposite happened. The U.S. dollar actually strengthened significantly against other major currencies right when the crisis was hitting its peak.
Wow. So totally counterintuitive. Why? What drove that?
It really boils down to the unique role of U.S. Treasury bonds. They are seen globally as sort of the ultimate safe asset.
The go-to panic button.
Pretty much, yeah. When Lehman Brothers collapsed in September 2008, triggering maximum fear, there was this massive, almost desperate rush out of anything perceived as risky corporate bonds, other currencies, you name it.
Did everyone piled into?
U.S. Treasuries. The demand was just enormous, coming from everywhere, institutions, foreign governments. People weren't chasing returns. They were just looking for safety, for capital preservation.
So much demand that it pushed yields way down.
Exactly. Yields on short-term treasuries went practically to zero. People were willing to earn basically nothing just to know their principal was safe, backed by the U.S. government.
Incredible. And because everyone needed dollars to buy these treasuries.
That massive demand for dollars to execute those treasury purchases is what drove the dollar's exchange rate up so sharply. Even with the crisis originating in the U.S., it was a powerful demonstration of the dollar-treasury nexus as the world's safe harbor.
Okay, so the dollar defied expectations. What about the other safe havens? Did gold do what people expected?
Gold behaved much more predictably. It's often seen as that barometer of fear. When anxiety is high, investors often flock to gold.
Right, as something tangible outside the financial system.
Exactly. And the source notes its price, the producer price index for gold, shot up nearly 25% between 2008 and 2010 during the worst of it.
And then?
Then, as things started to calm down a bit, say 2010 to 2012, and the global economy showed signs of recovery, gold's price fell back down, about 22% by 2012. So it had acted like that classic fear gauge.
Okay, that makes sense. What about the yen?
The Japanese yen also appreciated, which was interesting because it was pretty unique among Asian currencies at that time. And a strong yen can have big ripple effects, as the sources point out.
Because Japan's a huge exporter.
Right. A stronger yen makes their exports more expensive, which can complicate things for global trade and markets.
Yeah.
The source even uses the phrase wreak havoc.
And the Swiss franc.
Yeah.
Quickly on that one.
The Swiss franc also strengthened, living up to its safe haven reputation. But its overall impact on global markets was much smaller compared to the dollar, gold, or the yen's moves.
Okay, so pulling it all together, 2008 really showed us that while we have this list, dollar, yen, franc, gold, treasuries, their behavior isn't set in stone.
Not at all. It's complex. It depends heavily on the specifics of the crisis, where the fear is, what assets are hit hardest, and where that global pool of capital sees the most trustworthy refuge.
And sometimes, like with the dollar in '08, it just throws conventional wisdom out the window.
It really does. It highlighted how the dynamics of the crisis itself can override those static historical expectations.
Which leaves us, and you listening, with a really interesting thought to chew on. If the behavior of these established safe havens can change so much depending on the crisis, does that mean the actual list of what we consider a safe haven could also change in the future? Could new assets emerge? Or could some lose their status depending on how the next crisis unfolds? Something to think about.